Hello, my name is Matthew Granger and this is the FCTO Weekly Review and Outlook for the week of August the 13th, 2012. Despite intra-week setbacks, risk markets managed to close the week on a strong note, with the S&P 500 closing above the 1400 psychological level. Most major currencies strengthened against the dollar, but the euro didn't follow. Indeed, the common currency was the weakest one, along with the Swiss franc, and Spanish 10-year yield is back at the 6.9% level. Weakness of the euro in crosses were more apparent as the euro-Canadian dollar dropped to a new record low last week, while the euro-Aussie dollar was close to a corresponding level. Steep sell-off was also seen in the euro-sterling after the Bank of England cooled speculation on rate cuts. Meanwhile, the Canadian dollar took turn to be the strongest currency last week, as the Aussie and Kiwi were both dragged down by weak trade data from China. Technically, whilst the risk rally might extend further in the near term, we'd like to point out that risk of reversal, or at least a pullback, is increasing. The S&P 500 is now quite close to this year's high of 1422.4 and is starting to lose some upside momentum in intraday charts. A similar picture is seen with the Dow Jones, which is approaching this year's high of 13,297. A more important development to note was the CRB commodity index sell-off on Friday, after spiking to 306.54 on Thursday, and bearish divergence conditions were seen in the daily moving average convergence divergence of the CRB. The loss of momentum with the Aussie and Kiwi dollars compared with the Canadian dollar could also be taken as a sign of exhaustion in the market, in particular with the Aussie dollar US dollar now close to an important trendline resistance at around the 1.068 level. The dollar index is also stubbornly holding on to its 55-day exponential moving average. Hence, we tend not to participate in any risk rally this week and would patiently wait for the signal to turn dollar long instead. In the US, the Fed Chairman Bernanke acknowledged that many US citizens are still struggling with difficult economic and financial conditions, although some key aggregate metrics, including consumer spending, disposable income, household net worth and debt service payments, have moved in the direction of recovery. In a pre-recorded video speech for a recent conference, Bernanke stated that macroeconomic indicators can sometimes mask important information. He also suggested economists make use of distribution of income, confidence about future employment prospects, and the ability of households to deal with financial shocks to gauge the economics of happiness of the people. The chairman's concern may signal that the Fed would do more to ease the economic conditions further, as most people are still struggling. Boston Fed President Rosengren indicates that a large-scale easing program is needed to stimulate growth in the job market in the US. In an interview with CNBC, Rosengren, a voter in the Federal Open Market Committee in 2013, called for an open-ended quantitative easing program of substantial magnitude. The program needs to be substantial enough that it offsets some of the shocks that we're getting from abroad and some of the concerns that people have with how weak the world economy has been. His comments, together with the Fed Chairman Ben Bernanke's comments earlier this week, raised further hopes that the Fed would soon implement a third round of quantitative easing as a boost to the US economy. In Europe, the European Central Bank's monthly bulletin noted that several countries and financial fragmentation hinders the effective working of monetary policy. The central bank urged Eurozone leaders to push ahead with fiscal consolidation, structural reform, and European institution building with great determination, and governments must stand ready to activate the European stability mechanism in the bond market when exceptional financial market circumstances and risks to financial stability exist, with strict and effective conditionality. Meanwhile, the ECB Governing Council member Neuer also said that the the ECB has the capacity to act within the terms of its mandate, and the operations will be of sufficient size to have a strong impact on the markets. Noy emphasised that the ECB is ready to intervene very soon, prioritising short-term debt markets. Standard & Poor lowered Greece's CCC rating outlook to negative from stable. The rating agency noted that it reflects the possibility of a downgrade if Greece fails to secure the next disbursement of the EU IMF programme. And the rating agency noted that deepening contraction in Greece implies a high likelihood that additional financing of as much as €7 billion is needed this year. Also, it's reported that the IMF is pushing Eurozone leaders to lower Greece's burden. In the IMF's view, Greece's bailout programme is hugely off track, and the organisation could only release further funds if Greece's debt could be reduced to a sustainable level, and that would involve lowering interest rates on loans to Greece. The Bank of England inflation report for August revealed the gloomy economic outlook anticipated by policymakers. The GDP growth forecasts were revised lower, while inflation is expected to fall below plus 2% from mid-2013 to 2015. The unusually uncertain economic outlook is mainly due to the sovereign debt crisis in the Eurozone and whether officials would implement sufficient measures to resolve the crisis. After presenting the quarterly inflation report, Bank of England Governor Mervyn King said that the major conditions necessary for a recovery are in place, and further rate cuts could be counterproductive as it could damage some financial institutions. His comments cooled expectations of a rate cut. As expected by the majority of analysts, the Bank of Japan ended its August meeting with no change in the monetary policy. As both the Fed and the ECB refrained from delivering more easing measures in August, it has become less urgent for the Bank of Japan to act this month. Yet it does not mean that the central bank will stand on the sidelines for the rest of the year. We believe the next trigger for the bank to act would be after the Fed's third round of quantitative easing announcement, a move expected to send the Japanese yen even higher. The Canadian dollar was supported by Bank of Canada's Governor Carney's comment that the Canadian economy is in a very different place than other advanced economies and may hike interest rates if the economy continues to grow above trend. The comment suggested that the bank is still leaning towards a tightening bias in sharp contrast to other major central banks which are talking about additional easing. And the expectations overshadowed the weak employment data and maintained the Canadian dollar as the strongest currency last week. In line with market expectations, the Reserve Bank of Australia left the cash rate unchanged at 3.5% in August, although inflation has softened in recent months. The central bank decided to take a wait-and-see mode for 2 months in a row, following 2 consecutive rate cuts in May and June, by a total of 75 base points. Despite signs of economic recovery since the last reduction and the lack of indication of further rate cuts by the central bank, we believe the bias of interest rates is skewed to the downside, and we look for further easing later this year. In its quarterly monetary policy statement, the bank raised 2012 growth forecast to 3.75%, up from May's projection of 3%, but expects a slowdown in the second half. Meanwhile, the CPI projection for 2012 was also raised to 2.5%, up from the prior projection of 2.25%. Also, the central bank expects the inflation rate to be in the top half of its target range throughout 2013, with help from the carbon tax. The new projections now raise the possibility that the RBA is done with its current easing cycle, but the developments in Europe remain key. Meanwhile, the RBA also warned that the persistently high level of the Australian dollar exchange rate may be more contractionary for the economy than historical relationships suggest. and important risks revolve around exchange rate developments. Deterioration of the sovereign debt crisis in the Eurozone and the economic slowdown in the US hurt China's export demand in July. China's trade surplus narrowed sharply to $25.15 billion in July from $31.72 billion a month ago. Export growth declined to plus 1% year over year, compared with plus 11.3% in June, reflecting a weakness in global economic activities. Import growth also dropped to plus 4.7% year over year from plus 6.3% in June. As the July trade data disappointed, the RMB would likely stay around $6.3 so as not to hurt exports further. This set of Chinese economic data for July indicated that slowdown in the world's second largest economy continued in the second half of the year. Previous easing measures appeared to have done little to boost economic activities, as shown in the July data. Going forward, we believe the government would add more easing measures in terms of reverse repos and a reserve requirement ratio cut. However, the more appropriate and likely timing would be in August, as inflation had probably bottomed in July. The central bank would probably feel less comfortable to ease aggressively as inflation rebounds. And that's it. For more detailed analysis and daily updates on all the news affecting the Forex market, join us throughout the week at www.forexcurrencytradingonline.co.uk. That's www.forexcurrencytradingonline.co.uk.